Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, June 4th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the one big ugly bill survive Senate scrutiny? Our answer, Elon Musk called out President Trump's tax and spending bill, called it a disgusting abomination as Republican fiscal hawks like Senator Mike Lee and Rand Paul echoed criticism. In response, House Speaker Mike Johnson called Musk's stance very disappointing, and the White House defended the legislation as one big, beautiful bill. Senate Majority Leader John Thune said failure is not an option on raising the debt limit, with Treasury having previously forecast the U.S. would exhaust borrowing authority by August or September. Thune also said the House SALT deal must change to move forward. The size and scope of the SALT cap increase, debt limit increase, Medicaid work requirements, and clean energy tax credits are all key avenues for performative congressional brinksmanship that investors should fade as the One Big Ugly Bill Act gets legislated this summer. In our view, there is a high probability that ABBA, the One Big Ugly Bill, survives the reconciliation process intact. There is a reasonable probability it actually gets bigger in terms of its impact on growing the national debt. And in our risk management nomenclature, when we say high probability, that means 75% or above, and reasonable probability is 50 to 75%. Moderate probability is 25 to 50%, and low probability is 0 to 25%. In addition to Elon's outcry, Tesla Energy warned that cutting Biden-era EV and clean energy tax credits would, quote unquote, threaten America's energy independence and the reliability of our grid. A message Musk boosted on X amid rising Republican opposition to the bill's climate rollbacks. We've consistently signaled that fiscal largesse was partially responsible for perpetuating the K-shaped nature of the U.S. economy, and Tesla's whining about the tax credit repeal reminds us that rich people who run companies like Tesla, SpaceX, Palantir, etc., make multiples more money annually from federal government outlays and tax breaks than poor people. Yes, the system is rigged. But until Congress turns the fiscal spigot off, the U.S. economy is likely to remain resilient due to the outsized influence that rich people on the top part of the K have on economic activity. Reminder, bullish paradigm C actually turns the spigot up, not off. So be aware of that. Transitioning to our 42 Macro dashboard, as always, a wrap up with a question from our community. This one's regarding taxes. It says, hi, Darius. I see that KISS performs better than the S&P in general. However, how does it perform versus S&P with long-term buy and hold strategy? As opposed to the constant buying and selling of KISS when you add in taxes. So good question. Two things I'll correct. So KISS does not perform better than the S&P. We don't benchmark KISS against the S&P. KISS demonstrably trounces the thing that we're benchmarked against, which is the 60-40 portfolio. And then we also benchmark KISS to a naked long portfolio featuring 60% stocks, 30% gold, and 10% Bitcoin, which is what KISS is when it's maxed out, but it's not always maxed out. So the KISS will raise cash when the risk management overlays tell it to raise cash. And so, when you benchmark KISS versus, fully invested at all times, 60, 30, 10 stocks, gold, Bitcoin, it has an upside capture ratio of about 90% and a downside capture ratio less than 50%. So essentially you're getting 90% of the return you would get being fully invested at all times in 60% stocks, 30% gold, and 10% Bitcoin with less than half of the downside. So if you wanted to be naked long, 60% stocks, 30% gold, 10% Bitcoin at all times, you would get 100% of the return and 100% of the downside. What KISS does is chops off the left tail of the distribution while continuing to expose you to the right tail of the distribution with its 90% upside capture ratio and below 50% downside capture ratio. So that's what KISS does in a nutshell, is it gives you the opportunity to remain invested when you're supposed to be invested, while also allowing you to sleep comfortably at night, knowing that you're not going to blow up your family's nest egg, face volatility drag, and the hope and or despair of having to hope that your portfolio can recover from a market crash. I think a lot of investors my age, have never lived through a sustained bear market. The last sustained bear market we had ended when I started my career back in early 2009. And so as someone who's been on Wall Street for as long as I have, who has many institutional contacts and clients as I have, and has been around the world many times over, educating and collaborating with institutional investors, Darius Dale has never actually lived through a durable bear market. And so think about that. I'm almost 40 years old. So think about all the people who are younger than me that have never seen or experienced a durable bear market, especially not with enough money to actually care about. And so to me, I think we've all gotten very used to max drawdown recoveries that are very short in length in duration. It used to be the case that max drawdown recoveries from these durable bear markets take years. And if you're at or near retirement, you don't have years to recover from losing 20 to 30, maybe even 40% of the money that you spent your entire life accumulating. Again, you spend your entire life saving money, and if you suffer a crash, you're going to lose 20, a minimum 20% of the money you made throughout the course of your entire career. You're going to lose 30% or more if your portfolio goes down by that. So that's what KISS is designed to do, is to put sophisticated institutional grade risk management overlays, the kind of risk management overlays that you see being employed at many of the top institutions across global Wall Street. We're taking that and we're bringing it to 42 macro to retail investors around the world, because guess what? They deserve it too. Everyone deserves the opportunity to have their portfolio risk managed by sophisticated, institutional grade risk management overlays. And so I'm just really grateful that we have thousands of clients around the world that are participating in this. And so before I answer the question, there's one other thing I will say with respect to KISS. So it says the question asks, the question says, opposed to the constant buying and selling KISS. That is a flat out misnomer. There is no constant buying and selling of KISS. KISS trades way less frequently than the average retail investor. There are only 2 trades per month on average in KISS. That most retail investors are out there trading their accounts more than 2 to 3 times per day. We're talking 2 trades per month on average. And so KISS is a low volatility, low turnover investment strategy that is designed to expose retail investors to asset markets in a way that helps them retire on time and comfortably, while chopping off the left tail of the distribution that helps them sleep well at night throughout that entire process. That's it. And so if that sounds good to you, then obviously come check out KISS. But getting back into this question in taxes, because to me, I think this is a very important question to answer. When we talk about taxes, first thing I'll ask is, whenever someone asks me about taxes, is whose taxes are you talking about? Not only do we have our own individual tax situations as people, in terms of some people are trading in a tax advantage account, some people are trading in a taxable brokerage account. There's different, we have our own tax situations as people. But guess what? 42 Macro specifically has clients in 80 plus countries around the world. I think a little more over half, let's say somewhere 50 to 55% of our client base is international. So you're talking about 80 plus tax jurisdictions, with people with different tax situations in each of those jurisdictions. I mean, you're talking about like a near infinite number of potential tax, combinations. We can't build an investment strategy to satisfy all those different tax combinations, but what we can do is give them access to sophisticated risk management overlays that help them eliminate volatility drag from their portfolio. It's up to them how they choose to implement it. I think the smart people who are following our KISS process, following our KISS process is, in my opinion, smarter than the average retail investor, because they figured out that this stuff is better than what they've been doing. Those are the smart people. But the smartest of the smart people are obviously transacting in tax advantage accounts, obviously. So that's one way in which you can get around the fact that, risk managing financial markets sometimes requires you to have taxable gains and or tax losses. So just be aware of that. And by the way, you can't get tax losses. You don't get the benefit of tax losses if you are a long-term buy and hold. So also be aware of that. Those things probably wash out over the course of time. And the thing I'll say is another thing on taxes is, your question about how you should be treating exposing yourself to financial markets is really it's really incumbent upon who you are and where you are in your investment journey. If you're a young person, say younger than me, you have decades to recover from a crash in your portfolio. And so buy and hold, it makes a lot more sense for you for some, in terms of being able to, recover any max drawdown that you suffer in your portfolio. You have time for the markets to recover. Now, if you said that in 1968 or 71, guess what? You didn't recover for, a decade plus. So just be aware of that. But, you have time for markets to recover. So if you're a young investor, but if you're, let's say, 50, 55, 60, 65, someone at or near retirement, you don't necessarily have time for your portfolio to recover from a significant drawdown of, let's say 20% or more of the amount of money you spent your entire career accumulating. Again, you go to work 5, 6, sometimes 7 days a week over the course of multiple decades to save the money that you save in your retirement account. If you lose 20% of that, it's equivalent to losing 20% of all those work days that you just basically pissed away because you are too arrogant to manage risk, or you think you think the markets are going to recover very quickly. One of these crashes, the market's not going to recover very quickly. I don't know which one it is. I think we'll have a very high probability forward-looking scenario on that outcome whenever it occurs. But I'm not smart enough to say when that eventually occurs. But guess what? Eventually, markets are going to go back to do what they used to do, which is go down for a long period of time and take a long period of time to recover. Again, everyone my age and below has never experienced that in their investment portfolio or in their investing career. It's just not something we've had an opportunity to experience. But I guarantee you, it will happen to you. And these silly questions, and no offense to the client, but these silly questions about taxes and managing risk and just, we'll start to make a lot more sense. What I'm saying right now in response to the question will make a lot more sense. So just be aware of that. That's one thing to consider. So kind of in summary, taxes is not something you can build an investment strategy around in the context of having clients in 80 plus countries around the world, with all their individual tax situations and their brokerage account configurations, or in terms of being tax advantage or not tax advantage. You can't build an investment strategy for that many variables to account for that many variables. And also, by the way, if you're a young person, buy and hold makes a lot more sense to you than if you're someone who spent 2, 3, 4 decades accumulating assets so that you can have assets to finance a comfortable retirement and also leave your kids and your community behind some wealth. So these are all things you have to consider as an investor. But the number one thing I would say on taxes in general is, at the end of the day, you kind of just have to decide, are you going to be someone that risk manages properly and avoids volatility drag, or are you going to suffer volatility drag and one day wake up 2, 3 years after a crash and realize that your portfolio has not recovered its previous high watermark? Because that's going to happen at some point. And I think a lot of these, what I consider to be silly questions about taxes will go away exactly when that happens. So we'll wrap it up there. Darius still here presenting our macro minute for, was it Wednesday, June 4th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.